Basics of irrecoverable debts and provision for irrecoverable debts. When there is an increase in irrecoverable debts, it leads to an increase in irrecoverable debts and a reduction in trade receivables. Therefore, the double entry would be debit irrecoverable debts account and credit trade receivables account. Now, let's look into provision for irrecoverable debts, short form PFID. When there is an increase in provision for irrecoverable debts, debit income statement and credit provision for irrecoverable debts. In this case, the value of irrecoverable debts would increase, whereas the expenses would also increase in the income statement. Therefore, the impact on income statement and the impact on SFP would be income statement expense would increase, therefore it will reduce the profit for the year. Whereas in statement of financial position, from your trade receivable, you deduct the amount of provision for irrecoverable debts for the year because there is an increase. Suppose if there is a reduction in provision for irrecoverable debts, debit provision for irrecoverable debt account and credit income statement. So here it will increase the value of other income. Let me show it below. It will increase the value of other income, whereas it will reduce the provision for irrecoverable debts. That means from your trade receivables, you reduce the closing balance. The impact would be income statement to increase other income value, therefore increase provision for profit for the year, whereas in SFP, trade receivables, you deduct the amount of provision for the end of the year.